So our main topic is going to be broken divergence. The first thing we're going to do is we're going to cover what divergence is. Divergence is basically a difference between price action and MACDs. If your price action is leading higher and your MACDs are leading lower, that would represent bearish divergence. If your price action was leading lower and your MACDs were leading higher, that would give you bullish divergence. Now, when you have divergence, a difference in price and a difference in MACDs, what the divergence is telling you is that there is a potential for a reversal in the trend of the market. That's it. It is simply an indicator that says there's a potential for a reversal in the trend of the market. Now, you have to now look at some of the other indicators that we have to determine whether or not the area or the divergence would most likely hold or break. Now, we're going to visualize basically a trend. So here we have our trend. Now our trend is heading in this direction. Now in this case, we are in an uptrending market. We are in an uptrending market. Here the market trend is up. You're making higher low pivots and higher high pivots. The market has been trending to the upside. Knowing that the trend of the market is heading to the upside, divergence is basically an indicator that says that there's a potential for a reversal. Now when you're looking at the trend versus the divergence, typically we're going to assume that the divergence at this point would be a bit weak. It would be a little bit weak because your large trigger lines are wide and spread apart to the upside. That means that not only are you in an uptrending market, but you are in a very strong uptrending market. Your large triggers are wide and spread apart to the upside, and your price action is pulling away. Strength and momentum. And we never anticipate that the strength and momentum will reverse when our triggers are wide and spread apart and price action is pulling away, because there's really no sign of a reversal. The trend is strong and is showing you that it's expected to continue with that strength and momentum. Strong because they're wide and spread apart. Anticipated to continue with the strength and momentum because the price action is outside of the large trigger lines. So at this point, this little thin line that's really not standing in the way of the trend will represent your divergence. Here you would simply expect that the trending market will continue. Now when you start looking at the other indicators, such as your large triggers and your Fibonacci areas of support or resistance, when you start scrolling the chart forward a little bit, you can see that your price action is breaking inside and then begins to break below your large trigger lines. That means your uptrending market is now weak and is showing you the potential to reverse. Weak and has the potential to reverse. Now the divergence will pose a threat. Now the divergence will stand right directly in the middle of the trending market. Weakness with the potential to turn. You have an indicator that says that there's a potential reversal, and your other indicator is confirming that that reversal may occur because your uptrend is weak and is now showing you that it can reverse to the downside. When you add in a Fibonacci area of resistance, When you add into the equation a Fibonacci area of resistance, that is a big indicator. It becomes a big proverbial roadblock that will back up your divergence. Divergence, resistance, and weakness in the large trigger lines. Three things that are trying to stop this trending market. This is where you would expect the trend to turn around and go in the opposite direction. This is where that you would anticipate that the trending market will turn around and go in the opposite direction. In this case, your uptrend may reverse into a downtrending market. Your uptrend may reverse and go into a downtrending market. Because you have a lot of things that stand in the way of that trend. Now, when you scroll forward and you see that the trending market has continued, the trend broke through the divergence high. It broke through resistance. It even broke back above your large trigger lines. This is what you would consider broken divergence. Instead of the trending market reversing, it actually breaks through the divergences. It basically breaks through your roadblocks. And the trending market simply continues. Now at this point, because it managed to smash through these areas, because it managed to break through these areas, your trending market is now going to be considered a very strong trending market. The trending market had three things that stood in its way that said that the trend of the market would reverse. You had divergence, you had resistance, you even weakened the trending market with a potential to turn, and the trend continued. It kept on going. You broke through your divergence, you broke through your large triggers, you even broke through the fib. It means that not only are you in an uptrending market, but you're in a very strong uptrending market, one that you would not anticipate to reverse. Now, when your divergence breaks through those roadblocks, you may see the similar roadblocks appear in your way. You will often have another divergence occur as your MACDs will trend to either go strong down or work up another divergence. When that happens, you will anticipate the divergence to break. You may have another Fibonacci area that stands in its way. When that happens, once again, you can anticipate it to break and simply keep on going, breaking through any roadblock that stands in its way. If it's done it once, it will most likely continue to do so, and you will simply expect it to continue to do so until you physically see it reverse. So eventually you're going to come across some type of roadblock. Eventually something is going to stand in its way. Or eventually the trending market will simply reverse. Once you see that the trend has started to go in the opposite direction, in other words, you're never going to anticipate it to do so, but once you finally see that it's starting to go in the other direction, then you can start to say, okay, my strong uptrending market is over and now I'm in a downtrending market. Now you can look at your Fibonacci areas, the large triggers, and your MACDs as you once did before. Because your strong trend would be over and you're back into a normal trending market. Now typically in a strong trending market, you'll anticipate that the trend will simply continue until you physically see it reverse. So what will happen here is that the market may simply continue from the areas such as the large triggers or your support line. Now take a look at what's occurring here once again. Look, you have another roadblock. See how the price action's leading higher and yet your MACDs are once again leading lower. That's giving you a new divergence. You also have resistance. You have a divergence, you have resistance. You start even to get inside of the trigger lines. The divergence is telling you that resistance should hold because your MACDs went strong down and weak up. And what happens? The divergence breaks, resistance breaks and turns into support. In other words, the uptrend still continues. Now, when that happens, when your uptrending market continues in its strong trending up, basic up, like we said, your MACDs may go strong down. They may even give you another divergence. And that divergence may also, once again, be at resistance. There may be other indicators that are showing you that the trending market may once again reverse. As your MACDs lead lower, as you break through your large trigger lines, and all when that happens, you'll simply anticipate that the uptrending market will continue. And you'll anticipate that the uptrending market will continue until you physically see it reverse. Now, that means that every chance you get to take a trend trade, when you hit the mid-band, which is of course a great area for the trend of the market to continue. You hit the mid-band, it's an area for the trend to continue. You have support, an area for up. Anytime you have indicators that the trending market can continue from, even though some of the indicators may start showing you that the trend may reverse. MACDs going strong to the downside, large triggers pinching and rolling, starting to turn to the downside. You'll simply anticipate that the uptrend will continue until you see it physically reverse. So that gives you opportunities to take trend trades. From the mid-band, which is again a great area for the trending market to continue from. When you begin to lose momentum, you can always take your exits and look for a re-entry. Simply, once again, anticipating the trending market to continue. Now, a lot of times what will grab your attention are the MACDs, and the large trigger lines. A lot of times that will grab your attention. Like in this example right here, what's grabbing your attention? The fact that you've hit resistance, the fact that your MACDs have gone extremely strong to the downside, you've even broken back below your large trigger lines. You have a lot of indicators that are saying that the trending market may reverse from here. Under normal circumstances, that's exactly what you'd anticipate. But when you have broken divergence, it represents a strong trending market, and that means that that uptrend can simply continue. So each time you get an opportunity to take a long trade where you can anticipate that that uptrending market will continue, it's exactly what you'll look to do. Take the long trades, anticipating that strong uptrending market to continue. You may be below your large triggers, and the uptrend will just break back above them. You may have resistance, and the price action will once again break back above. Your MACDs may have gone strong to the downside, and yet they'll cross back over the upper Bollinger Band and go wide and spread apart to the upside. And the uptrend will simply continue. Simply put, a strong trending market, anticipate the uptrend to continue until you physically see it reverse, or until your uptrends or your trend trades stop working.